Hello everyone. So in this video, we're going to be quickly summarizing what we internally think about Arvind Fashions as a business. So this is one of the businesses that we recently covered as part of the microcap series. And for those who are new, those who are uninitiated, so we started printing 2 to 3 business research notes about promising companies across sectors. So we started this in, I think, May or June of 2024. So we've been printing 3 business research notes on a monthly basis. At this point of time, we have covered, I think, approximately 45 companies as part of this series. So just a small disclaimer before we further talk about the business. So this is not a recommendation to buy the stock. This is just, sort of summarizing what our research work has told us so far in terms of the strengths, weaknesses, and whether we are really excited about this business or not. Whether we really end up buying this or not, at what price will we buy, when will we buy. So we don't have tangible visibility into that now. So we cannot say anything for sure. So with these disclaimers in place, we would want to, just get into the details of the business. So the first thing that we like about this business is the promoter intent. I think the Lalbai group has shown a lot of intent in terms of, focusing on the consumer business, and they have done a lot of activities which are pretty much in line with, I would say, long-term shareholder wealth creation. So that's the first tick mark for us. Even in terms of the way the organizations within the Lalbai group are structured, right? So there's a very clear focus in terms of, who the next generation of promoters are going to be, who will sort of own each of these businesses, and to what extent are they really sort of, focusing on this, right? So the second point that we really like about this business is the fact that they got a very, very strong set of brands. So they have US Polo Association, they have this combination of Tommy Hilfiger and Calvin Klein, right, which are immensely profitable businesses and really, really premium brands. The other 2 brands they have as part of their stable right now are Arrow, and they have Flying Machine, which is one of the oldest denim brands in India, right? Now, within this, we would say that 3 of the brands are doing very, very well. Arrow and Flying Machine currently are being laggards, but we have reasons to believe that the future could be, slightly different from what the history has been for these 2 brands, right? The third point that we really like is the promoter focus on capital allocation. Now, starting from 2019 and 2020, the business has, hived off so many brands which were subscale, which were not really core to the company's operations, and which were not really making money for the company. So the focus right now is very, very clear that we have 5 flagship brands, and we're going to be putting in every ounce of our energy into trying to, scale the market for each of these brands. The third point that we really like about the business is something that follows from actions number 1 and 2, which is the capital allocation. So if you go through the investor calls, I think the focus is very, very clear that the gold standard for evaluating this business in the eyes of the promoter is going to be ROC. So they're saying we're going to be doing things that will be very, very, ROC accretive going forward, which means the business is going to be asset light. They don't see themselves doing too much of, I would say, either manufacturing capex or even channel capex for that matter. So the focus on capital allocation, the focus on improving margins, the focus on ensuring that the balance sheet is very, very clean and pristine, it shows up in the historical financials. So they have been steadily reducing debt in this business over the past 2 to 3 years. And there's a high probability in our assessment that the business could actually turn out to be debt free in maybe a couple of years' time, right? The fourth point that we really like about the business, and this is very, very important for a consumer business, this is what we firmly believe. So well executed category expansion, where you have very clearly defined offerings for various customer segments, and then you have a very, very clear distribution strategy in terms of how we are going to be reaching those consumers. So the channel approach needs to be, omni-channel. You need to know where exactly you're going to be placing those products. So there's a lot of early data points that we believe that indicate that the company is on the right path. So footwear for that matter. Is currently about 300 crores of annual revenue. Kids wear under the CK and the Tommy Hilfiger brands are currently clocking about 200 crores of annual run rate. So I think these are all very, very good indications. They've also, gotten into categories like innerwear, casual wear, which are still fledgling. But we believe this is something that can actually pick up the pace over a period of time. So the fifth point that we really like is the clarity and the execution of the management on the balance sheet front. We've seen a lot of consumer businesses actually make this mistake in the past, where they decide to go very, very aggressive on expansion. So they end up doing manufacturing capex, they end up doing channel capex, Their channel strategy is not really in line with the entire brand positioning. So the balance sheet basically ends up swelling up a lot, right? So there are countless examples of consumer businesses getting this wrong in India. So the management thought process in this case is very, very clear, saying that we're going to be doing outsourced manufacturing, right? We're going to be containing the working capital cycle to a level of 60 days, right? We're not going to be giving too much of leeway to the franchise owners or to the online partners to be able to do deep discounting. So the extent of discounting that these products are subject to has definitely come down over a period of time. The last point, which we believe is going to be very, very critical going forward, and this is where we think the management once again has done a pretty good job, is they have started to show a clear-cut improvement in the cash flows and in the EBITDA margins. So a business that has a lot of debt, initially they had to do a fair amount of equity dilution. So they have used that money to sort of clean up the entire balance sheet. They have reduced debt to a very, very manageable level right now. And the operating cash flows that the business is able to generate is now going towards, paring down debt. And number two, obviously, it is going to try and improve the EBITDA margin of the business over a period of time. So I think the delta in terms of the EBITDA margin is probably going to come from Arrow and Flying Machine. In the words of the management, if you look at the current P&L in terms of the pre-Ind AS, accounting standard, both these brands are probably clocking between 3% and 4% EBITDA margin right now. The expectation is that over the next couple of years, as they have already rationalized the number of stores and they have rationalized the entire inventory, what will probably end up happening is, this is the expectation from the management. So they expect that these two brands will probably start clocking something in the range of 7%, 8% EBITDA over a period of 3 to 4 years. Now, both these brands put together would probably account for maybe 1,000 crores at a top line, roughly. So the overall impact at the EBITDA level could probably end up being 100 basis points over the next, say, a couple of years, with maybe 50, 60 basis points showing up in FY26 as well. So these are these are the many things that we really like about this business. So what really stops us from going and investing right now? Number one, we are not yet really sure in terms of whether the consumer discretionary spending pickup has achieved critical mass in India. So we are very eagerly looking forward to the Q2 and more importantly the H2 financial results for the entire consumer pack. Now, Arvind has printed something like, I think, 14%, 15% revenue growth in Q1. The management guidance says that the revenue growth could probably be in the range of 12%, 15% for the next couple of years. So we look forward to Q2 and H2 results to see if that is something that is on the track, or has the management been, let's say, a little bit too optimistic on that particular front. So we're definitely looking for more tangible data points in terms of whether the consumer spending in India has really come back on track. And number two, the stock has seen a pretty steep run up from a bottom of around 365 to a current level of around, I think, 520 as we speak today. So valuation and let us say the growth outlook over the next 2 to 3 years. So these are the factors that we are really looking to get a better handle on before we take a decision in terms of, what we want to do about the stock. So feedback welcome. Thank you.